Good morning, traders. Thanks God it's Friday. We write down February the 16th, and we made it to the end of the week. Well, nearly. Still have a little bit to come, but we're nearly there. So courage for the rest of the day. Right, Ryan will not be with us today, so this is Cayman. I'll be your host for this session. So let's kick off straight away with what's going on around the world. And a couple of lines on China, even though they won't be really live online until next Monday. But over the weekend, I've seen some news that they should announce what they plan to do with the medium-term loan facility. And most in the market expect that they are going to leave the 1 year unchanged. That should come out on Sunday, if I'm not mistaken, unless I'm a week too early, but I think it is on Sunday. People are thinking that due to a bit of renewed weakness in the Chinese yuan and also in the light of all the plans that they have been putting in place, that they may wait for the rates to be lowered until actually the data start to turn up a little bit. So we may be in for a little bit of a wait there. In the meantime, reports coming out that their New Year's related travel has ramped higher. We are about 30% higher apparently than last year, sorry, compared to last year. It did not underpin the Chinese yuan too much, but perhaps, just perhaps, there's a few green shoots here and there in the for the Chinese economy. We will have to see how that develops. But first, let's get those rate decisions out of the way on Sunday. Moving over to Japan, couple of comments from Suzuki again, saying that he is closely watching the FX market with a high sense of urgency. In the meantime, though, he said that the same lines, stable moves for FX are desirable. They must respect the independence of the BOJ. It's up to the BOJ to decide monetary policy. Yeah, well, we'll see about that. And he is aware there are various opinions in the financial markets about the fate of negative rates. So he is sort of giving the green light also to the Bank of Japan to start hiking. So they also won't comment on FX interventions as usually, and he added that the weak yen has merits and demerits. There was absolutely no impact on the yen. As we can see, the yen is trading relatively weak compared to the other pairs again, and that is mainly thanks to Ueda, who are saying that he was expecting wages to rise slightly more than inflation forecast of 1.8% for fiscal year 2025. So he's still pushing back against rapid or swift normalization or hiking of the rates. And he says he has no comments on short-term fluctuations in the FX markets and factors behind the move. Of course, it's not up to the Bank of Japan to decide whether they would intervene or not. That is purely a decision taken by the Ministry of Finance, Suzuki and Kanda and their friends. So that for Japan. We had then in New Zealand, RBNZ OR was on the wires yesterday. Only one line that stood out still is that the RBNZ is still needs to anchor inflation expectations. Not much of a mover, but still pushing back against expectations or against people thinking that the central banks may start to cut sooner rather than later. In fact, as we know from ANZ, they think that the RBNZ may still even raise rates before starting to cut them. I don't completely subscribe to that opinion, but let's see how that develops. Closer to home, or let's first stay in the US, perhaps. We heard from Bostic that they said that there is still some time for the 2% inflation to come into view. But the sticky inflation that we saw earlier this week does not change his opinion that inflation is gradually coming down. Then White House Brainerd, remember she's now at the White House where she was at the Fed before, said that the US won't follow Japan and the UK into recession. So for the time being, we can only adhere to that position for the time being again, because the only thing we see out of the US is our soft landing numbers, even though, and I'll come to that in a minute, we saw those data on the retail side of things taking a bit of a hit yesterday. One for the diaries then. Note that Fed's Powell, is to testify before the House panel on the 6th of March. So make a note of that. That is going to be the next date. It's still a while away where we should hear from the big man then. Right, moving closer to home. We had an interview in Les Echos, a French newspaper yesterday, by the French ECB member Villeroy. And he is clearly back on his dove train. And he said the risks of cutting too late are at least as big as cutting too early. He also said, what did he say? He also said that they are really on the way to meeting inflation goals. Yeah, most of it was really dovish. So that today was countered a little bit by our German Schnabel saying that they must still be cautious not to adjust monetary policy stance too early. So we're seeing in the ECB this diverge between the hawks and the doves getting bigger as time goes on. I think yesterday morning also, Lagarde said was rather still on the cautious side for not starting to cut too early either. So that's the divide we have to reckon now with within the ECB. They know as much as we know. We're all data dependent. And then over to the UK. So we had those by-elections yesterday with the results coming out overnight, and the Tories got hit really, really hard. Labour won the two by-elections in the two constitutions, and they overturned two big Conservative majorities in the process. So that's putting again more pressure on Sunak. In the meantime, Jeremy Hunt has already dropped the plans to cut the income tax from 20 to 18% on the back of those weak GDP numbers. It's not really helping them at all. And then straight away, let's look at what happened this morning on the sterling. And we see sterling is roughly where we opened this morning. We had those better retail sales coming out. And so we had a 20 pip jump in the cable. I'm going to show it when we will look at the rates. But the by-elections are apparently overshadowing what's going on in the sterling right now, because we had a dip in euro sterling as well, came down 15 or so pips, and we are back to where we started. So we have, as we already mentioned, we have to take into account what's going to happen on the political front now as much as on the data front for the sterling going forward. So keep that in mind. I don't know exactly when there are the next by-elections somewhere, but it does seem that even though we're seeing green shoots in the UK economy, for at least on the consumer front, and that is what Bailey and other officials had been telling us. We see those green shoots, but then we need to take into account what's going to happen in between the parties. Traditionally, although for now the watchers are saying that it may not be outright as negative sterling as it was traditionally in the past when a Labour government takes over. It still shows us that the market is cautious when those Labour members are taking over from the Tories in those elections. All right, so I have to take that into account. Just give me a sec. Excuse me. Right. Sorry, I'm back. Okay, I think for the main lines, that is what happened overnight. Let's move over to the data. What did we get? Well, we got where the US consumer was holding the fort very, very well up to yesterday. That seems to have had a little bit of a change, where there was a small positive expected on the control, for instance, where there was a small positive expected on the core retail sales, they both went into negative territory. It is sort of as expected by some of the bank strategists, as we have been saying yesterday. So this miss is not completely a surprise, but still it is a bit of surprise. It could be a January setback because we had better than expected resilience from the consumer up to December. Remember though that December number was a beat, and now we are in give back territory. Is it enough to turn around the whole sentiment on the dollar? I would argue no, but we have seen that the market still loves to sell some dollars, and on each week number, they're pretty swift in giving the dollar a bit of a knock on the head. Of course, that's helped by what's happening in the equity markets as well. We're seeing the S&P, the Dow as well yesterday. The whole spectrum of the US equity markets went higher. That de facto, per correlation, has a bit of flows coming in the market, a bit negative dollars, but for the time being, the majors at least are very stable, but the market still loves to sell dollars, or at least doesn't like to hang on for too long to dollar longs, thinking that we could see a return in those in the consumer, and always waiting for the jobs market to start to collapse. The thing is, it got a bit of help from the Philly Fed, okay? Even if the capex was much better and the prices paid were higher, the employment and the new orders index remained in negative territory, okay? So that was a bit of an additional push in against the dollar, even though the headline number beat. So it's still a case that the market likes to look at the glass half empty when it comes to the US economy and to the dollar. Again, right or wrong, I leave that in the middle, but I still think personally the dollar isn't dead yet. So we will see what happens later today, because we have another set of data out. Then we had the IP, and that gave another little push lower in the dollar, although not that much, stabilized afterwards. A bit lower capacity utilization, but then the IP, and that was a bit of a, shall I say, surprise, but it went a little bit against what we saw in the IP, for instance, in the Eurozone, where even Germany stuck its head above the waterline and printed a bit of a positive number there. The US number was not positive, came in a little bit weaker. So those are things to watch. Of course, we are mainly also watching the services, etc., but still, this is a part of all the data that we have to take into account. We had a bit of really short-term bill auctions, but only next week the US Treasury will come back into the market with the longer-term auctions. Maybe I can show you the upcoming calendar quickly. That is what waiting next week. So we will have the short-term bills. There will be another biggie coming in, but then we also will have a 20-year, we have a 30-year, and we have a 2-year. That's for next week. Okay, so there's going to be more supply than we saw this week in the for the Treasury auctions. Yeah, that is something that we need to always keep an eye on for when we look at the yields, which are still a major driver of what's happening in the markets. Okay, So that for the US data. Then we had Waller, didn't give us anything on monetary policy. He was talking about the status as a reserve currency of the US. Wouldn't expect anything different than him saying that they are still on top of the pile. What else? Yeah, we had a beat of the Kiwi business PMI, still below 50 though, but we did see a bit of a beat. And then here, the Japanese foreign bond buying stepped up again. We saw actually on the prior bond auctions that the indirect were going up. That is what I've been talking about. The Japanese whales or Japanese investors, even though if they're waiting for what's to happen on the Japanese yields before stepping more actively into JGBs again, they still have to put their money to work. So that is what we found here. It does support somewhere the dollar yen, but if they're all hedged bond buying, it's not going to do too much in the yen. That ratio I have not seen yet. And then this one, foreigners' investment in Japanese stocks, record levels, still record levels. And I will show the Nikkei. We are on very lofty levels in the Nikkei. Those numbers are, of course, helping. Everybody is still piling into equity markets in general, but the Nikkei in particular. And that's been going on for a year and a half now, since Mr. Buffett said that he had a lot of confidence in the Japanese markets. Everybody is still piling into that. That is really a long-term trade that's been going on. Now, next, I spoke about the retail sales here. We had the final French CPI out. That came out completely as expected. No revisions, just like 0.1%, which is really, really small. Moving on from there. Bit of Swiss in IP also diving into negative territory, where the revised was 0.2% lower as well. So that, I'd argue, doesn't really change much to the Swiss situation right now. Okay, looking forward, what's next on the docket? As I said, we have the PPI out today. It's expected to tick up just 0.1%, the core as well, 0.1%. It's looking at what's happening in the dollar so far this week. We had this move up and then the pretty swift give back to levels where we started the week. It may mean that it won't need too much of a miss here for some currencies to gain a bit more against the dollar. And I'm particularly looking at stuff like the Aussie and the Kiwi, perhaps the sterling. I don't really know, but there's an interesting level there as well coming up, as I will show. The yen may be a little less impacted by it, and then the euro is still extremely stable. We're going to have to break ranges before that is really going on the move. And that's going to be about it. Yeah, we have those constant Atlanta Fed GDP now revisions. Yesterday, the one coming out brought us back to just below 3%. From 3.4%. Oh, yes, we do have the Michigan as well out this afternoon. I nearly forgot about that. So last time, I think we had a beat last time, but I guess more than this number, it's perhaps the inflation expectations again that we need to monitor, which have been relatively even and a bit sticky of late. But watch those in particular. If the number here would not come out too far from expectations, those have actually bounced. I think if I'm not mistaken, those have seen pretty decent bounces over the past readings. Okay, so if ever we would get a miss, that would also put a bit more pressure on to end the week on the dollar, perhaps. Right. Moving on. Let's go into what's happening on on the rates. And in the meantime, just starting to read. Good morning again to all who joined. Ali, what are you saying? That's question. We're sitting here on desk dreaming of becoming a professional trader. Can we make monthly income? How much most of the traders expect per month? Which percentage? That's going to be a difficult one. We could do 2 sessions on that one if we start to talk about that. Right, that's a big question to answer. Okay, right. Okay, if I find the time at the end of the session, I'll perhaps come back to that. Okay, but that is a very complex question to ask. Okay, euro dollar. Yeah, look where we were. We had all those spikes down. Then we went to test the 107. But look where we started, and where we started, and where we ended the week, and where we always have a little move back to 107.70, and we are again trading around there. It's really been since we've broken down below the prior, let's say, bit of a range. It's really been a magnet, this level. So we have seen that the FX vols are coming off, and we really are going to need to move above 90, 80, 107.95. I'd argue even 108, the figure, hold there, and ideally move above 108.30, 35 to see perhaps more of short-termers or small, medium-term players running for the exit, perhaps. Those who have no positions may also look at those levels to see that, oh, perhaps we can go for a retest of the 108.70, 75. But we have seen how difficult it is to keep moves going in this pair. The overall trend is still there. The medium-term trend is still there. We have to, as I said, we will have to break above at least 108.30, 35 to start moving. But we've also seen that the downside has seen some pretty decent bounce here. So I'd argue that, again, if we get an overshoot on the numbers this afternoon and combine PPI and the Michigan, I'd say, we are going to have to break back below this 107.10.25 to go and have a look below. If that would happen, then I think finally next week we may be on our way to those low 106s. But again, I'm keeping an eye on what's happening in the equity markets. Equity markets are going up. That mechanically is keeping a bit of a lid on dollar moves as well. You know, we've been arguing that despite all those equity rallies, dollar is still doing pretty okay. That is correct. Correlation algos have not seen too much of a move in their direction, but still, there's still going to be some small correlation flows, probably keeping a bit of a lid on the dollar. Cable here, 126.10, okay, 126.10 bounce, 126.10 lows here. It's been trading in that zone also for a long while. Broken below, went back above, but still for the short term, I think 126.10 is going to be your level to watch. And then you are talking, if that would go about 126.40 again. If that would give way, then there's probably something more going on with the dollar, and then we could perhaps go and have a look closer to the 127 level again. In the meantime, we are turning around this this 50% level. That's the 50% of that move that we saw at the end of the year. We've seen that in quite a few currencies. You know, we did the end of the move here, then we corrected a lot, and now we are hanging around this 50%. So decision time, yes, no. Of course, numbers, yeah, can always decide upon the direction. But since those vols are coming off, we also have to know, and I've been talking about that already quite often, that the lower the vols, the more people are finding it cheap to buy options. But that also means that if you go towards the edge of ranges, you will find more and more interest to counter them, because those people want and need to buy back, need to make back their premium that they pay. So you're going to have increased interest on the edges of the ranges, and that is something that we also need to take into account when we expect moves, or when not for the medium term, not for the longer term, but at least in those short term data coming out, unless they really take us far away from expectations, we have to know that those option flows are likely going to counter the reasonable moves. So getting from 125.90, for instance, I'm just taking the cable as an example, and it probably works even more in stuff like euro, dollar, or a couple of others, perhaps Swiss also as well. But is assume that we are having a bad number and that we are stalling here at 126.40 and then slowly starting to come off. That's probably because those option longs have had their 50% move, and they go like, oh, right now we need to hedge a bit of our option, so we are going to sell some out. And the same thing happens here, and that's pretty similar move. That's the 125 and a quarter, 125 the figure. You probably, if we get a move down there, probably will get the same crowd who has been paying up for straddles, like options that try to take advantage of both ways. You will probably see people coming to the market and try and start to hedge their options on the other side again. So keep it into account. We are going to need breaks for things to keep going. So when you have positions and when you see these kind of moves, whether it's on the downside or the top side, or at least that's what we are doing. And I know Ryan is the same thing, but I'm doing it a lot, is that when I have, like, for instance, just for instance, I'm short cable. If I'm seeing even those lows here, 125.40, and anywhere down into the 125 and a quarter, I will buy bits and pieces back. If it breaks, we can always add. But if that theory about the option players is right, it is going to gradually get back up, because they will absorb flows in whatever happens, and especially they will absorb the short-term flows if there's no big involvement, if there's no like big hedge funds or asset managers going for the break here, or needing to sell a lot. They will absorb the short-term flows. Okay, so that's what I'm regularly doing. Moving on, euro sterling. 85 is big. It's getting bigger and bigger. Okay, so it's also, and that's thank you to Simon in our room. We have also seen the completion of this move here right there as well. So technically, psychologically, it's a big level, 85. Okay, it's a very big level, right? On the top side, we have moved back to those little zones here that we saw, and especially, recall what I was saying, that there seems to be supply coming in, especially when we were going lower here, supply coming in here, and what happened on the rebound, on the weaker GDP, we saw supply coming in here as well. And of course, now with the better retail sales this morning, that is giving this level just that little bit more importance, all right? If, and that's an if, because right now we're really very stable in cable, actually going back up just slightly. If there would be some nervosity with the main players in the sterling, and euro sterling would go for a break here, then I think we could be rapidly back into the 86.30 zone. Okay, but we need to see how nervous the main players are going to become on those elections. If not, I think we're in for some more range trading here as well. All right, I'm not overly tempted by anything right now in euro sterling. I'm really going to be patient and wait for breaks for those trading ranges. That's your range, and we're starting to build a little bit of support here as well. So on the tight 35.70 perhaps to start. Right, Aussie. Well, no surprise. This trend line here is also coming in again. That's from a bit longer term. 25.40 still the level. All right, but where we have had pretty much immediate rejections the other time, we are well here we hovered around it, but then we had those better US data. We are no, is that the week? Oh, this one, the week you Aussie unemployment. But we are trying to break the short-term trend line. We're still in this 25.40. There's a bit of a Trump level here, perhaps at 45. This is one, and actually I'm very tiny short, but it is one where I'm kept the position really small because I want to trade the level, but I've also got the impression this is one of the currencies that won't need too much of a miss for it to break. And I guess I'm not alone in being short on the Aussie, okay? Um, if that 40-45 goes, then I think we may be in for a bit of a revisit of at least 65-70, but even those levels here around 66. Okay, this is one that I'm very cautious on. Yeah, that's the only thing I can say about this one. Kiwi in the middle of the range. I'm not really going to spend too much time. Look at this range. We need to break this one to get going on the top side. Still the same level, 40.65. Okay, and the downside still the same level. Have to get back below 60.65 and especially 60.40 to get to start going again. All right. Swiss. I did the Swiss, right? Did I the Swiss? Yeah. Consolidation. No, I didn't yet. Consolidation. And remember, I showed you the weekly cloud. This is coming right here as well. Trend line, 61.8. You name it. Everything's happening here. 88, 85 figure. What happened? We consolidated. That's what I've been saying. This possible consolidation going on. It's a big level. Now, we did go visit the first support, little support here. I'd say on a miss today, we could go 87.5 for, and then even though 85.5 is a big level, okay? But for the move higher to continue in between brackets comfortably, I would say we should be holding. If ever we get a retest, we should be holding just below 87. Okay, this is a level I would like to hold for the move to continue to be comfortable. All right, I know it's over a percent from here, but it's still a data Friday, and on Friday a lot can happen. Of course, this is a level that I'm going to watch quite carefully. Okay, on the Swiss, I'm still nursing my option. I did hedge quite a bit more here, started to buy back, still have a bit of hedges running. I will take them off if we get back into this zone and then monitor what's happening. All right. Yeah, I wanted to show you that Nikkei. Look where we are, and I'm just going to show one picture, and that's the weekly. 1989, 1990, okay? We're back. We've just undone 30 plus years of moving of these moves. Come back all the way to those levels. All right, we hit the lows over the global financial crisis, and now we are back. All right, this has been storming back actually over the past year or so. All right. Also, pay attention. We've had this first move up from the after the pandemic and then down. We are also at extension levels here, and also FT was showing in our room how important those levels are. This is going to be psychologically very important. Okay, so keep an eye on what's happening next week when the Japanese market is coming back online, because a lot of times what we've seen when Japan is undecided is that Japan doesn't really participate for a big percentage in those moves, but it has over the past couple of months. Okay, they have participated over there. So this is like one huge move and a big level. Yeah. Are you talking about the Nikkei, Gavin, or that it may run out of steam, or about other stuff? Oh, all right. Um, yeah, I mean, it's logic, right? If you just undone the whole move, and if that's always a theory, right? If and when the Bank of Japan will start to raise rates, will this run out of steam? Very possible, because it's kind of a logic correlation between yields, rates, and stock markets. But then look at what's happening in the US markets and in other markets as well, right? So the thing is, equity markets have defied the laws of gravity, even with um, central banks raising rates, and there is like uh, a few dozen explanations for that, but there's one explanation that I keep coming back to, and that is liquidity. There's still a lot more liquidity in the system and more money in the system than there was before the pandemic, and especially before the global financial crisis. So that is one explanation, and money always has to go to work. One last one I would like to look at, and then I'll come to your question, Ali. And yes, I haven't forgot about it. Don't worry. You're quite a demanding person, I must say. Um, Euromex, we're still hanging around there. We have been showing that on the face show as well. Keep an eye on that 30-30-36 thing, because despite what people saying about nervosity, Mexican peso and stuff like that on the back of the elections, the Mexican peso is still doing relatively well. Don't forget, it is still an 11% currency, and we are in the dollar mix also hovering around those support levels. I'd say if you start to get below this trend line is coming down, this trend line coming down a bit here, but we could perhaps put another one here. Again, if you start to get below those levels, there may be deep buyers who need to call it a day as well. We will see on the back of the numbers this afternoon. Right, Ali, just in a couple of words. So again, I'm going to repeat what I said earlier. It is a subject of where to which we are going to spend hours explaining or trying to figure out whether to become a professional trader or not. Or listen, I am one, and I may not be like perhaps typical with all the retail traders, because I'm coming from a banking background. Personally, I don't have targets in mind myself, but I know which level I need or what kind of returns or what kind of money I need to make to pay the bills, as they say. And I'm going to tell you one thing, first of all. It's unless you are like taking very big risks, which is well, I sometimes do, but I mostly have my risk is pretty contained. Um, Unless you take very big risk, and then you risk to blow up your account and not even get to the stage of being a professional, it's something where you need to have a relatively decent account with, and it's tough to stick a number on it, because some people trade out of a $50,000 account, or some people need a $100,000 account and taking less risk but better returns or so. But if you, and I'm speaking a little bit against my own shop, but if you are a starting trader and you want to become a professional straight away, it's going to take you years, all right, to get there, because everybody, first of all, makes mistakes when they start to trade, and secondly, most of the traders who start, unless they have received money from here and there, they don't have enough money to be comfortable in having positions. Like say, for instance, if you, I don't know, if you pay and I'm thinking about perhaps like people living in an apartment or and I'm thinking about UK prices and I don't know the averages, but if you say like you're living in an apartment when you pay like $1,000 and then you have like $150 or $200, I don't know, energy costs, and because the energy costs have gone higher, and then you have your living costs, you have whatever costs you need to have a bit of insurance and here and there. That's going to bring you relatively quickly to something like $1,500 or $2,000, and that's for I'm staying very, very reasonable in the assumptions, you know. People live in more expensive places. People like to go out more. People like and they are going to need more. But so even that you're going to need just to be comfortable. Even that you're going to need to 2,000 strict minimum, but ideally, because you're going to want to be building on your stuff as well, right? So you're going to need ideally $2,500 to $3,000 revenue. So imagine that you have a $10,000 account. I'm just saying, imagine that you have a $10,000 account. That's a 25-30% return per month. Do you find that reasonable? No asset manager, no hedge fund manager, zero. Do you hear me? Zero of them are producing 25-30% return every month. That would mean that hedge funds, asset managers would return something in the zone of 5 to 600% return a year. Have you ever seen one that coming out with such a kind returns in ever? They may have like 1 year where they well, I just said that if you have a $10,000 account, you need 25-30% return per year, Ali. Okay, that nobody does that on a consistent basis. Whatever people say on Instagram, TikTok, wherever, they all those people trying to lure you into returns. Nobody makes that on a completely consistent basis. Okay, people make 15, 20, 25% per year, those asset managers, those hedge funds, 30, 40% in really good years, okay? So that means that if you want your return, if you want to live from it, that means that you're going to have a starting capital, which is a little bit bigger, because somebody who takes risk in a normal risk, you know, and you want to risk 1-2% of your account per position, let's say, you're going to need to have at least, as Brian said, at least a 50 or so, at least a 50K account. And that's still only my personal opinion, right? I mean, other people may have opinions. So the thing is, if you need to go professional, you have to have something on the side first before you even can start to go professional and live from it. Okay, this is demanding that you create first of all a kind of system for yourself that you're going to make a relatively decent return per month, and that's variable from one person to another. But if you take for instance a 50K account, you're talking about 10%, perhaps 6 or 8% per month. For a private trader, if you have a little bit of leverage, I would argue it's somewhere possible. But don't forget that every negative month, you're looking at the double or the triple to make back the later on. Okay, so I mean, it's all very, very personal, but it's something that you have to know if you want to do it to live from. You need a decent account to start with, because you will need to absorb a bit of losses on the way through as well. Dereji, 10 to 15% max, is that per year or per month? But let's say what? But 5 to 6% is very less if you have a 10,000 account a year. But exactly. So Ali, if you have a $10,000 account, it's going to be hard to make a living out of it, unless you're willing to be on water and never heat your apartment or never have hot showers on a month. It's very hard to live from a $10,000 account. Yeah, that's the thing, Gavin. Everybody needs to pay for the living expenses through trading losses as well. But again, so coming back to it, my personal opinion on this is that you need a reasonable account, and then you need an absolutely, I'm not going to say watertight, because we always have emotions. We always do a little bit wrong here and there or so, but you will have like a very, very, very strong strategy and an even stronger risk management in place to consistently live from it, okay? That is about what I have to say about it right now, because otherwise we are going, as I said, spend hours on the back of it. But feel free to join our community, and because we can talk about stuff like that in our community as well. Well, that I think is going to conclude our week. Don't forget PPI this afternoon, Michigan this afternoon. Be a bit careful. It's the end of the week as well. Friday, a lot of things can happen. And we will talk again on Monday. By the way, US is off on Monday, but we will have a flow show, I reckon. Ryan hasn't told me anything about not having the flow show. I think we will have the flow show then. So wishing you all a great weekend, and we speak again on Monday. Cheers, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.